With fears of a 2025 market crash looming, where can investors hide their money? What if I told you there are three Singapore-listed tech manufacturers quietly paying for the 6% dividends, sitting on more cash than debt, and building real products for global giants, all while flying under the radar? These aren't hype-driven moonshots. They're resilient, cash-rich businesses that can help shield your portfolio when markets turn volatile. If you're preparing for a turbulence ahead, these SGX stocks might just be your best line of defense. Hey investors, welcome back to Durian Finance, your home for deep dives into income and value stocks across Singapore and Asia. Today, we're diving into three of the most underappreciated SGX manufacturing stocks. Venture Corporation, the contract manufacturing giant powering global brands. Valuetronics, a cash-rich, no-debt dividend play in consumer and industrial electronics. Frencken Group, a precision engineering powerhouse with diversified global clients. We'll cover their financials, resilience, and finish with a head-to-head comparison to help you decide which fits your 2025 game plan. Quick disclaimer, this video is for educational purposes only and not financial advice. Please do your own due diligence or speak to a licensed advisor before investing. First up is Venture Corporation, one of Singapore's most reliable contract manufacturers, supplying medtech, instrumentation, life sciences, and consumer electronics brands. Let's break down the key financials of Venture Corporation and why it stands out as a resilient dividend play on the SGX. Starting with revenue, Venture posted 2.736 billion Singapore dollars in FY 2024, a slight dip of 9.6% year-on-year. That's expected during a global electronics slowdown, but still one of the highest top lines among SGX tech manufacturers. Despite that, net profit remained strong at 245 million Singapore dollars, giving it a profit margin of around 9%. That shows the company's ability to protect its bottom line even during headwinds. Its EBITDA margin, estimated at 10.2%, reflects tight cost control and healthy operating efficiency. But here's where Venture shines. Its net cash position is a massive 1.3 billion Singapore dollars. With zero long-term debt, this gives the company huge flexibility for R&D, acquisitions, or shareholder returns. Speaking of returns, it pays out 75 cents per share in dividends, translating to a yield of around 5.3%. This payout is sustainable and well covered by earnings and free cash flow. On valuation, Venture trades at a P/E of about 13.2 times. Not cheap, but fair given its strong financials. And its price-to-book ratio is under 2, reflecting a slight premium that's justified by its track record and balance sheet. In summary, Venture Corporation offers scale, stability, and income backed by a fortress balance sheet and decades of operational discipline. It's the kind of stock built to weather economic storms and reward you while doing it. Next up, Valuetronics, a Hong Kong-based manufacturer dual-listed in Singapore, focusing on industrial and consumer electronics. They may not be flashy, but they're quietly powerful. Here's our breakdown of Valuetronics, the SGX-listed electronics manufacturer for the discerning investor. Revenue came in at 1.67 billion Hong Kong dollars, $298 million, in FY 2024, down around 17% from the prior year, reflecting weaker demand in both consumer and industrial segments. Despite that, net profit surged nearly 30% to 159.6 million Hong Kong dollars, $29 million, showing strong margin gains with nearly 9.9% profit margin. On operations, EBITDA margin stayed robust at 12.5%, while gross margin expanded to nearly 17%, thanks to better cost controls and materials management. Valuetronics holds over 1.16 billion Hong Kong dollars, $200 million, in net cash, has zero bank debt, and a debt-to-equity ratio of nil, a hallmark of financial strength. For investors, yield matters. They paid 25 HK cent per share in dividends, giving approximately 6% yield with a 60% payout ratio, reliable and well covered by earnings. Valuation-wise, the stock trades an attractive PE of around 10.5 times and APB of 1.2 times, which looks modest for a debt-free, cash-rich industrial play. In summary, Valuetronics delivers strong profitability, zero debt, high dividends, and disciplined operations, all key quality for a crash-resistant, income-focused portfolio. And finally, Frencken Group, a global precision engineering firm serving the medical, semiconductor, and analytical industries. In FY 2024, revenue rose to 794 million Singapore dollars, up 6.9%, driven by growth in mechatronics and integrated manufacturing services. Despite macro pressures, net profit jumped 14% to 37.1 million Singapore dollars, yielding a net margin of 4.7%, signaling solid recovery. What about efficiency? EBITDA margin came in at 8.4%, with a gross margin of 14.5%, typical for a technically focused manufacturer. Turning to the balance sheet, net cash stands at 25.7 million Singapore dollars after offsetting 133 million Singapore dollars in debt, resulting in a debt-to-equity of around 0.31 times, which is moderate and safe. They paid a dividend of 3 cents per share, giving a yield of about 2.3% backed by earnings and free cash flow. On valuation, P/E is 14.5 times, EV/EBITDA 7 times, and P be 1.23 times, holding steady near book value, reflecting fair pricing. To summarize, Frencken offers steady growth, modest margins, disciplined leverage, and a reasonable valuation. It's a stable, defensive pick for investors seeking manufacturing exposure without excessive risk. Now let's compare these three SGX tech manufacturers side by side and see what makes each one stand out. In terms of revenue, Venture Corporation dominates with 3.3 billion Singapore dollars, followed by Frencken at 794 million Singapore dollars, and Valuetronics at around 2.3 billion Hong Kong dollars, or roughly 400 million Singapore dollars. But look at net profits. Venture again leads with 290 million Singapore dollars. Valuetronics follows with strong 222 million Hong Kong dollars, or about 38 million Singapore dollars, and Frencken comes in close with 37.1 million Singapore dollars. So all three are solidly profitable. On the balance sheet, it's impressive across the board. Venture holds 1.3 billion Singapore dollars in net cash. Valuetronics has about 170 million Singapore dollars. And even Frencken maintains a healthy 80 million Singapore dollars, all with little or no debt. For income investors, Valuetronics offers the highest dividend yield at 6.1%. Venture pays 5.3%. And Frencken gives a modest but stable 4.2%. On valuation, Valuetronics looks like the value pick here, with the lowest PE at 7.9x and PB under 1. Venture and Frencken are both trading at 13x earnings, but with premium branding and broader global exposure. In terms of debt levels, all three companies are conservative. Venture and Valuetronics carry zero long-term debt, while Frencken's leverage is low and well-managed. Lastly, on growth outlook, Venture expects moderate recovery. Valuetronics is doubling down on stable industrial niches, and Frencken is actively bouncing back with strong recovery in precision engineering and medtech. So whether you're looking for scale, value, or growth, each of these SGX stocks offers a different kind of resilience for the 2025 market cycle. So what's your style? Team Venture for blue chip scale and consistent dividends. Team Valuetronics for value, discipline, and high margin. Team Frencken for global recovery and growth runway. Either way, these three SGX stocks are cash-rich, dividend-safe, and operationally resilient, well worth considering in a volatile 2025 market. Which one are you buying? Comment below, Team Venture, Valuetronics, or Frencken. Like this video if you found it helpful. Subscribe to Durian Finance for more SGX stock breakdowns. And remember, cash flow and discipline never go out of style.